You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
The trading day doesn't start when the opening bell rings. Pros understand that risk never sleeps, and market-moving events happen around the clock. How can you arm yourself with the information you need to understand what's going on across the pond and how it can impact your portfolio? Welcome to the European Market Brief, your go-to source for information on the fast-moving European derivatives markets. Each episode brings you expert insights into the latest market trends, discussions of cutting-edge trading strategies, breakdowns of exciting new products, and analysis of thought-provoking trading activity. The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, V stocks, DAX, and European rates derivatives like the Bund, Bobl, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com. So join us as we shine a spotlight across the pond and explore the cross-border volatility, regulation, and innovation that makes the marketplace so fascinating. It's time to get the European Market Brief.
All right, everybody, that music means we are back. It is time to explore across the pond once again. It is time for the European Market Brief. My name, of course, Mark Longo from the Options Insider Radio Network, your home now for 19 plus years. How wild is that, of your favorite options podcast? Next year, the big 2-0. I wonder what we'll do. I guess we'll have to wait and see. In the meantime, a lot of fun has been going on here. Of course, if you're not checking out the Pro, you missed the one-of-a-kind. Well, really, we've done two of them now, but each one is completely unique. Yes, the Vol Death Matches last week was a banger. Going to have a fun Pro Q&A today as well, of course, Options Oddities, fun giveaways. Literally a dozen live streams coming at you every week, 2 exclusive shows, all sorts of fun extras like Vol Death Matches, and of course, giveaways every month because we like you folks. TheOptionsInsider.com/pro is the place to go to learn more as we learn who's joining us on this journey across the pond this week. First, to perhaps a volatility lake house near you, or perhaps to the ivy-covered halls of Indiana University, where we are joined once again by our good buddy, the once, future, and present Dr. V Stocks, a.k.a. Mr. Russell Rhoads. Mr. Rhoads, welcome back to Volatility. Ooh, wrong show. That'll be Friday. Welcome back to the European Market Brief, sir. You jinxed me on Friday. I blame you.
I apologize because I do think I put that little bug in your ear. So sorry about that. But yes, I'm on Volatility News, where we talk about V stocks and VIX every Friday. I can't remember the last time I couldn't join you guys. So I've become your Joan Rivers or your Ed McMahon, or I don't know, somebody like that. And all I have to say about volatility death matches is the nice guy always seems to win.
We'll leave it there. No spoilers. I'll let you figure out who the nice guy is in each of those vol death matches. Hint, Russell may be slamming himself in that comparison.
I might
be. And also joining us, making a return appearance on the show. I guess he liked it the last time. Holding down the Eurex hot seat this week, we have Rex Jones from the product development side over there at Eurex. Rex, welcome back to the European Market Brief, sir.
Well, I'm still in Europe, and I'm still with Eurex, and I'm still Rex. Yeah, it's great to be back with a different lineup today. Some other topics that not strictly on the options side, but I look forward to discussing futures roles.
Yes, we're going to rock and roll in a second, but before we get there, let's also bring on our guest for this episode. Joining us for the first time, she is the rate strategist over there at Deutsche Bank, Miss Mingyue Sheen. Mingyue, welcome to the European Market Brief and indeed to the network, madam.
Thank you, Mark. Thanks for having me.
And as we like to do with all of our first timers here, Mingyue, give our audience a bit of an overview of your background in the space, as well as what it is you do over there at Deutsche Bank.
Yeah, sure. I'm a risk strategist at Deutsche Bank and mainly focus on cross-country analysis across G10 markets, with more focus on the European rates. And I also cover the quarterly Eurex filters role, which we'll talk about later in today's podcast. In terms of my day-to-day, our goal is to deliver value to our clients through our analysis. So usually the first step is gathering information that we think our clients would be interested in. So part of our job is helping clients filter out the noise and focus on what really matters. And then we analyze the information from a strategy point of view. Sometimes we look at history, for example, how markets reacted during a similar event. And other times we look forward, such as estimating a fair value or thinking about what could be the next trading opportunity. And of course, it's not just about having a view, it's also about explaining why we think that way. So communication is also a big part of our job. So overall, I would say it's a job that is both analytical and requires logical reasoning.
All right, with the team assembled, I'm excited. I can see our chat is excited. Let's commence our continental conversation.
It's time to catch up with the thought leaders who are shaping the European derivatives markets. It's time to have Continental Conversations.
All right, everyone, welcome to the Continental Conversations, a portion of the show where we dive deep into a product or a complex or a strategy or sometimes all of the above and explore how you can utilize them in your own portfolios, things you should watch out for, and in general, we get you up to speed on what's going on in the Eurozone. And today we're going to be rocking and rolling in the rates complex. Now, I think for a lot of our listeners out there on the retail side in particular, I don't know if they truly understand the importance and the nuances of what goes on in the roll cycle each period out there. I was first really exposed to this when I cut my teeth in the SPX pit back in the day, and that's when I was really introduced to this roll culture. There's this roll phenomenon that goes on a regular basis, and preparing for it, there's a lead up to it, there's the execution of it, what prices, what levels is it going up for. It varies depending on the time of year and the cycle and all sorts of things that go into it. And it really is a trade, and even some might argue a subculture unto itself. And so that was kind of eye-opening for me. I think this might be a similarly eye-opening episode for our audience, where we're going to focus this time on the rates lens, because rates, all products have their own rules of engagement at the end of the day, listeners, and rates are no exception to that. Rates definitely play by their own rules of engagement. Maybe, Russell, before we start diving into the nitty-gritty and the nuances therein, let's look a little bit from maybe 10,000-foot perspective. You know, rolls, they're important in a lot of these big institutional products, equity indexes, rates, but from the lens of rates, walk us through why the roll is such a big part of not just the product, but indeed the culture of the rates marketplace, sir.
Well, I'm going to backtrack a little bit and just make sure everybody.
We're just starting, and you're already backtracking on me, sir.
Well, I want to talk about rolling equity, because a lot of people are more familiar with that than rolling fixed income futures, and there's a bigger difference than a lot of people would think between the two markets. For typically, and this is probably what your experience was, Mark, there was a day or two where everybody would roll their March positions to June. You know, we're probably coming up on that in the next couple of weeks for those products. And so what firms would do if they've got a futures position that's paired up with some other things, and it's kind of a longer term hedge, they're going to roll. I'm just going to assume it's a longer term position, market participant that's using them to hedge for one reason or another, or to increase or decrease their equity exposure. But at some point, you know, there's a window where a lot of market participants in the equity futures space will roll their contracts. My understanding with respect to the fixed income area is it's stretched out a little bit more. And it's a little bit more nuanced, and there is definitely a lot more to it. The Treasury future, or I shouldn't say Treasury, but the fixed income futures, they're sensitive, a bit more sensitive to what's actually going on in the interest rate market, to say the least. The predictability around the timing is, I think, one of the biggest differences between the two. We've got a really good idea as to when, and we used to refer to it as the top step. The March contract's going to roll out to June, and June's going to become the one on the top step. And again, the futures one might be stretched out over a few more days. Also, with equity index futures, you might see the basis widen out a bit, but in the fixed income space, it may happen as well, depending on what's going on in the markets. I think March of 2020 was a tough time for some rolling activity.
Why would that be a challenging period to roll? Yeah. I don't understand, Russell.
And then the other thing that's very unique to the fixed income markets, and I teach it as a concept, but I don't teach the math behind it, because when I did work in the bond pit in Chicago, every day the exchange would tell us what the cheapest to deliver bond was. And I assume that is shared as well over in Europe. But from day to day, the actual delivery vehicle might be slightly different from day to day. So that may show up as well. So there's just, I want to make sure everybody understands what we're talking about with the roll. In academically, if I wanted to hedge myself out to December of next year, academically, it should not make a difference as to whether or not I take the front month and then roll twice, or if I choose the longer dated futures contract. And for liquidity purposes, you usually want to be in the front month. In fact, I just looked at one of the contracts, and the open interest is around 200,000 or something along those lines, one of the contracts, and 160. It's 1.6 million of it is in March, and about 36,000 is in June right now. And that's pretty common until we start to see the rolling. But there is a liquidity thing that you want to take into account as well when you're using futures in that manner. And the roll, if done efficiently, really should not impact your position.
Timing, liquidity, we'll get to all that fun in a second, but let's start to kind of drilling down a little bit. I know for a lot of our listeners, maybe they're coming from a U.S. equity options perspective, and they're saying, roll, why do I need to roll? I have Apple options. They settle into Apple stock. It's all good. So the concept of rolling to them may be a little bit foreign. Let's start there, Rex, with the very basic premise that we're talking about. Futures, options on futures, obviously a very different ballgame when it comes to the necessity to roll. So let's start there. What are we doing? Why are we rolling when it comes to futures, Rex?
Well, all good things come to an end. And, with any derivatives contract, it does have an expiry date. And, we at Eurex, we cover fixed income futures products on some of the largest sovereign issuers in the EU. And, these can be used as proxies for other countries' debt. People will trade Bund futures, in response to having German government bond positions, but there's also highly correlated other European markets that they may choose, to hedge or to gain exposure with Bund futures for: Finnish, Dutch, Austrian, just to name a few countries who have very, very high correlations there. The physical delivery that's inherent in the fixed income futures at Eurex is really kind of what keeps pricing in check. Unlike the equity index world, where we often have cash-settled products and a relatively clear index weighting formula, so that I can make some pretty good assumptions on what cost of carry is and how I can really pinpoint my theoretical price. When doing those calculations on the fixed income side, there can be optionality in that respect. You may have 2, 3, 4, 5 different bonds that fall into the delivery window from a technical perspective. For Bund futures, we say a bond can have a maximum remaining lifetime of 8.5 to 10.5 years. There's currently 3 bonds that fall into that window. So, which of these is actually the most advantageous for me as a short position holder to deliver? We don't publish that information per se. It's available in Bloomberg. You can read it out. You can, read out which of the bonds has the lowest implied repo rate, and that one is typically the one that will, the short position holders will find most attractive. Now, in terms of timing, whole different can of worms. There's multiple dependencies that we can try to touch on there, but to keep it brief, in my what has gone beyond 60 seconds. They're physically delivered contracts. There's a delivery basket. The bonds are made comparable to one another with what's called a conversion factor. That's a relatively big formula that equates the different bonds in the delivery basket so that you have one central reference of a futures contract to gain exposure to that asset class. And you got to roll. If you want to stay invested, you have to either roll or you would take physical delivery. If I'm long Bund futures and I'm still long on March the 6th, I'm going to have to buy bonds that are delivered to me with a face value of 100,000 euros.
The challenge, listeners, of having an underlying, whether you're just trading the underlying or using it as a hedge, either way, your underlying has an expiration date, and that adds a new wrinkle to the game, unlike stock, which you can just have in that account forever, and it keeps just running along and chugging along like clockwork. Mingyue, Rex just touched on some of the timing issues. When it comes to rolling at the end of the day, timing is everything. You can't roll too early, obviously, because you still have a lot of other things going on. You still have a large residual position. Doesn't really make sense to roll too early. Obviously, you can't roll too late because that also poses a whole bunch of other problems. So the challenge is to really find that sweet spot. You're over there on the strategy side over there at Deutsche Bank and looking at a lot of what the clients and end users are doing. When do folks start lining up these rolls? And from your perspective, when is really that sweet spot to roll in the rates?
Yeah, sure. Usually I would say most of the roll takes place in the 10 trading days before the first notice day. And the most liquid period is normally between 2 and 8 days before the first notice day. But in practice, many investors already start thinking about the roll and even earlier than that. Sometimes maybe 2 to 3 trading days earlier than the most liquid period. Yeah.
All right, so a lot to continue unpacking there. Mr. Rhoads, you kind of already touched on some of the nuances and differences between equity and rates rolling. As we're drilling down here a little bit, any other nuances you want to highlight and perhaps distinctions you want to highlight for our listeners, sir?
Well, not necessarily comes into too much play, but the delivery options are slightly different, which might come, if somebody doesn't want to be delivered deal with physical delivery, that can be an issue. And again, paying attention with the equity index futures, you've got a good idea what the underlying is, but the underlying might vary on you a little bit, and there's some risk associated with that when you're trying to come up with the fair value for the for treasury futures or for futures that trade on Eurex like that. I think the Bund, the Bobl, and the Schatz are the 3 that I've paid attention to in the past, and they've they do have a physical delivery, which means you'll end up with a government bond as opposed to a cash settlement with respect to equity index futures contracts. So because if you're short the contracts, you can choose which eligible bonds to deliver. That can again come into play a little bit when you're trying to figure out if there's any basis risk or pricing risk associated with your roll. You don't want your roll to have a negative impact on your overall performance. So And this is a very, very large institutional market where, I know of traders before we went fully electronic that would basically make their living 4 times a year just being around for the rolls. And the rest of the time they're just goofing around on the trading
Yeah,
floor.
the roll was kind of what they were there for.
And there was a reason, because they were able to take money out of the market, 4 times a year, just based on trades that they knew were coming in. One of the nice things about having a window as opposed to a couple of days where everybody knows it's going to happen is you might be able to be a bit more strategic when you're rolling in the Bund Bobl shot space, as opposed to like the Eurostox 50.
You used to have those guys who'd come in just for expiration day back when it was once a month. What a quaint concept. Other guys would come in just for the roll. There was kind of their specialty. I see in our chat, they're asking, is this the same thing as what they call in Natenberg a jelly roll? I love that term. I always loved that term. I only encountered it ever in Natenberg. I never once heard anyone in actual trading parlance ever refer to it as a jelly roll, but nonetheless, it is a great term. My favorite, jelly-filled roll. So I think he got a little creative with that naming convention in that book. But Rex, Mingyue and Russell kind of just broke down that we have this window for rolls. When you're watching this market, from your perspective, when do people really start rolling? What is that key moment to really start getting the rolls off? As I mentioned, you kind of don't want to get going too early, and you definitely don't want to get going too late. When do you see most folks really roll in their positions?
I think it also depends on the underlyings of the different fixed income futures that you're looking at. So people may take a more benign approach to an uncritical roll where there is no shift in the cheapest to deliver underlying bond from one quarterly expiry to the other, because there's no nuance in there. There's no uncertainty. There's no pricing difference. There's no duration differences between because it's essentially the same bond. If you have something like a Schatz futures, that'll tend to see a much more, or Bobl futures, just by this being 2-year and 5-year contracts, there'll be additional considerations that you need to take into account in terms of repo pricing of the underlying bonds. And, there will more likely be a switch in the cheapest to deliver. So price levels will differ between the two. There's different underlying bonds moving those. There's different repo rates being asked for these bonds in the markets. So those are considerations that you would have other than, the timing aspect that Mingyue alluded to. And then you were mentioning, Mark, that roll specialists came in back in the day, and they still do so also in electronic markets at Eurex today. We still have a good number of proprietary trading firms who are specialized on providing the institutional market with the liquidity that they need to get the 2.5 million contracts of open interest in Schatz futures through that ever tighter funnel the closer the expiration date comes. And even though, we're still 2.5 weeks away from the delivery date right now, there's tens and in some products, hundreds of thousands of calendar spread prices already available for trading today. So, there's more liquidity actually at hand than is currently being utilized, as Russell alluded to. The open interest is still very much concentrated in the March contract right now. The roll is just kicking off. We're seeing 2 to 3% of daily volume trade in the back month futures. But yeah, I mean, it's an art and a science at the same time. And I think in the course of our discussion, we'll be able to collate a checklist of things to look for: historical patterns, pace of the roll, volume concentration days, tightness of pricing, when quantities really explode for execution.
Mingyue, Rex kind of just broke down some of the nuances we're seeing here. Obviously, when we're talking about rolls, we're talking about a massive migration of liquidity from one month to the next here. As a strategist, as you're watching this roll period commence, what are some of the telltale signals you're looking for to let you know, okay, roll season is commencing? This liquidity is starting to move from one period to another, Mingyue.
Yeah, sure. The first signal we look at, as Rex just mentioned, is the open interest in the back contract. And that's also how we track the progress of the roll. And another indicator we monitor is when the back contract was last traded, especially early in the roll period, because there may be only one or two price data point for the back contract if you check Bloomberg. So in practice, if we want to calculate the roll using the front and back contract, we need to make sure we match the front contract price at the exact same time as the back contract. So that's how we monitor the progress of the roll and the liquidity.
Russell, any thoughts on some of the additional nuances you see out here when it comes to the rates complex executing the roll? And also, an even more important question for you. Have you ever encountered the term jelly roll in the wild, sir? Or is it just from the Natenberg book?
I think I've only heard. I don't even think that Overby includes that in his book.
No, not.
And he's got everything in there.
He makes up a few terms.
Yeah, we all tried to do that. I tried to do that and it never worked. So no, Rex hit on the thing that I was kind of remiss with, and I kept talking about the cheapest to deliver bond. The cheapest to deliver bond can be different for the two contracts that you're looking at. So there's just if you're rolling from March to June, so that's something that you have to take into account. Also, there can if a lot of people want to take delivery, and we're in that period. You can start to see a little stress on the spot bond market where people are having to step in there and buy bonds because they're going to have to deliver on the contract. So you can see a little bit of extra volatility in the spot market when we're getting close, when we get close to expiration and when lots of people are rolling, et cetera.
So Rex, obviously, I think our listeners are starting to pick up that this is a highly nuanced process. You don't want to do it too early. You don't want to do it too late. There is very much a sweet spot. There's also a lot of other nuances there, not just timing, but of course, price. There usually is a baseline level that you want to pay for these things. You get a little bit too above it, you're kind of paying too much. Sometimes you can get a deal, but that's not usually the case. Are there any other nuances you want to lay down for our listeners when it comes to rolling, particularly through the lens of the European rates market, sir?
Well, we touched on why you need to roll. We could surely also say something about how you can roll. Very much like a 1990s movie, there's a hard way of doing that, and there's an easy way to do that. I think the hard way to roll is to do it individually with the single leg contracts. If you're long 100 contracts in the front month contract and you want to stay exposed, your rolling would require you to sell 100 contracts in the front month and to reopen them in the back month. You'd be crossing bid offer spread twice. That has higher transaction costs attached to it. Derivatives exchanges like Eurex typically offer what's called a calendar spread market. So I think we would keep the term jelly roll reserved for options-based strategies, and we would talk more about calendar spreads. If futures is checkers, then options is surely chess. So we'll try to keep it simple for the futures market. Now, in the calendar spread books, it's a combined order in two different expiration months. So buying the calendar spread basically means I'm buying the front month and selling the back month simultaneously at the same time at the price that constitutes the difference between these two contracts. So if I'm long, I need to sell the calendar spread to stay long in the back month contract. And the beauty of using the calendar spread for that technically as an order type that you can access through any of your retail brokers, ISV solutions that you may have, or through your direct exchange connectivity, is that you only pay bid offer spread once, and you get two for the price of one. Now, I'll pause there for a second, but not quite yet, because Eurex utilizes something that's different on the fixed income side than what we operate with on the equity index derivative side. We also interconnect these three markets. So not only do we have liquidity specialists who come in and provide liquidity, the technical trading system, the electronic trading system also implies prices out of the front month and the back month into the spread book itself, but it also does so retroactively. So it's like a three-way triangulation of prices. Front month futures, spread price can imply a price out into the back month. Front month and back month imply a price into the spreads. And finally, all good things are three. The back month and the spread can also imply a price into the front month. So you get this liquidity enrichment during the roll that's also facilitated from an electronic trading perspective.
But Rex, jelly roll is such a tasty term. How can we not use it here on the show?
I was always a friend of Twinkies, to be honest, and just regular donuts. But yeah.
Now I want a good tasty jelly.
You know, the funny thing about jelly rolls in Germany is they're actually called Berliners.
Yes, yes. Kennedy's famous speech was actually "I am a donut," but no one knew that in the U.S. and in the Germans just smiled and laughed along with it. So yes, a very, very famous incident. We're talking now. I want a jelly roll here, but yes, you're right. It does mostly refer, I should say, to the options side, but it is such a tasty term. We had to throw it in. I forgot who in our chat put that in there, but I blame you for derailing us. Mingyue, we're talking here about the nuances of rolls. There's obviously also different types of customers who like to execute their rolls in different ways. Some of them, you know, they don't want to wait around for that sweet spot. They want to kind of just get it done, get it over with. So the second really it becomes viable to roll, they're going to jump in and do it early. Others, maybe they're busy. Maybe they don't want to deal with it. Maybe, I think for a few of them, maybe they're waiting for a deal, which often doesn't tend to roll around, pun intended. They tend to do it maybe right up until the last minute. As you're watching the market participants, what do you notice from those who tend to maybe jump the gun a little early versus those who wait until the very last minute to get their rolls done, Mingyue?
So some investors trade the roll actually very early because they see there's some mispricing in the contract. And one example is the very early roll in the 30-year Bobl contract this year. Some investors started trading the roll as early as January, partly because they saw the mispricing in the optionality. And for other investors who prefer to roll within the euro roll window we just mentioned, they may trade actually more aggressively toward the end of the roll period. This is especially true just before the position limits apply to them. So overall, the roll behavior can vary over time depending on their objectives and positioning, I would say. Yeah.
All right, Mr. Rhoads, sir, we've talked about a lot of the different nuances of the rolling process, the timing being early or late. Rex hit on whether you should leg it or use some of the quoted products. Hint, don't leg your rolls. Only a madman goes that way. But I suppose maybe there are some who like to roll their own, pun intended. But outside of that, Mr. Rhoads, are there any other nuances or perhaps maybe mistakes you see from traders coming to this for the first time and really first coming to grips with the rates roll landscape, sir?
Well, one thing that you know we talk an awful lot, and the audience is very familiar with the volatility term structure. And we talk about how it can get inverted and then be in a normal contango shape periodically. This holds true for fixed income futures markets as well. And you know, sometimes you're actually going to be selling a higher price future and buying a lower price future, or vice versa. And in fact, I just went through the Bobl, Bund, and Schatz, and it looks like the Bobl marches at a premium relative to June. And the other two, it's the other way around, that June is at a slight premium to the Bund and the Schatz. So yeah, you can actually see slightly different shaped curves. You know, we talk a lot also about the derivative markets predicting what's going to happen with interest rates. If you've got a view on interest rates or how that may change, I do think that may come into play, and this is beyond my analysis, but I would feel like that would come into play with respect to how you go about rolling. If you think you know that the interest rate market's not correct right now, and we're not going to get a change in rates in Europe for some time, or you think that we're going to get a cut and it's going to start working its way into that market, you might want to roll a little bit earlier or not, because that would change the shape of the curve. So there is a term structure component to this. And again, this is not a market that I'm focused on from day to day, but I have to feel like there are people that do and are probably very strategic about how they go about rolling, especially because the liquidity is there across a wider time frame. The same thing wouldn't happen in the equity index space or a lot of other futures markets, just because in the equity index space, you have the same deliverable basically for the March and the June contract, because that's not necessarily true in the fixed income markets. You can see some shifting in those relationships that goes beyond just time value of money and the normal factors that we take into account when we're pricing out futures.
Well, Rex, Russell just brought up liquidity. That is another big topic, an area of interest when we're talking about rolls. You mentioned before the different ways you can access that liquidity, whether legging it or probably the preferred method. Use some of the more regularly quoted options, pun intended, out there to make your life a little bit easier. Probably going to get a better price there as well. We also have this question coming in from our live chat. I would normally save this for the red phone segment, but it is very much germane to what we're talking about right now. This comes from the queen herself, Miss Options Queen. She always has good questions. And she wants to know, Rex, does liquidity ever temporarily dry up during major roll periods, or is that largely a myth? So a twofer for you, Rex, on liquidity during roll periods. Anything you want to add there for the listeners and indeed for the queen?
It's news to me that it's dried up in fixed income futures at Eurex. I think there's, surely differences in terms of the time horizon in which our markets are open. You may find markets to be somewhat wider during our Asian trading sessions. So, from 1 a.m. Frankfurt time to say 6, 7 a.m. Frankfurt time. There's that kind of general rule of thumb that, and this is applicable to futures rolls and to outright futures trading in general. There's very good volume on the open. There's even better volume during the European morning. I think the peak of liquidity and executable volume with the lowest market impact is surely at 7 a.m. Chicago time, 1400 Frankfurt time, when the Chicago and U.S. markets enter into that equation as well. So there's this overlap of Treasury futures and Bund, Bobl, Schatz futures trading, where there's a lot of interproduct positioning going on, besides the country-specific yield curve dependent positioning that people may be invested in. So the roll will dry out. Surely on the last trading day, volume is not as good as it is 3 to 4 days before then. Once the rush and everybody is through the floodgates, things do change. That's what we've kind of been talking about. You don't want to do it too early. You got to get that porridge just right. And you don't want to do too late either, because you'll get caught off cold.
You're squarely in the myth camp then there, Rex. There you go, Queen. Great question. Russell, if you have anything you want to add on that, and also if you want to dive a little bit, we're talking about a lot of listed rolls here, but there's also OTC's rolls going up in the fixed income space. If you have any thoughts on the nuances or differences therein as well, have at it, sir.
Well, I wanted to touch on the liquidity thing just for a sec. Admittedly, and Rex said this, the last few days of the March contract, everybody is going to have moved out to the June contract, and there may be some issues around that. I've had a situation where I had a March futures in a different market, and I kind of missed the roll. And the last day before that expiration, it was not a pleasant experience as far as and that's in a completely different market, and that's in a U.S. market. But these, I'm looking at the back month in the Bobl right now, and it's one tick spread, and there's several thousand on the bid and several thousand on the offer, and it's the same thing with the March contract. And So they're extremely liquid. I do think maybe if you miss that window, you might, you've got to be aware of rolling. You want to have something on your calendar to pay attention to what's going on in those markets. If you start to see the open interest drop in March and gain in June, pretty good indication that people are starting to roll. And much like any trade, you don't want to be the last one out, although I don't think it, again, would make a big difference unless you just got right up next to expiration where all the volume has moved to the next contract. I do think there might have been a little bit of a dislocation in 2020 due to just everything in the world not working out quite well, but also the European QE might have made the underlying bonds a little bit less liquid than people would like. And there might have been a small issue around that, but I don't think in normal market circumstances, liquidity on the roll is going to be something to worry about too much. As long as you're not holding the March contract till the day before expiration. And Rex, you can totally correct me on all of that. I'm not the best market structure guy sometimes, but I feel like I'm pretty accurate with what I'm saying here. You're more than welcome to say, nah, not necessarily true. But I think maybe that's where the Queen's getting that was just from something that happened, over half a decade ago. And God willing will not repeat itself with respect to COVID.
So you were a late roller, it's fair to say, Mr. Rhoads.
I took my eye off the ball roller because I was at spring break.
We used to as well. We used to as well. We used to try to get the best deals. Didn't always work out that way. Yeah. And I can't imagine why March of 2020 would have been a difficult time to roll. I mean, what else would have been going on in the global macro perspective that would have complicated things?
And I do want to say that it is much less expensive and a lot more efficient with electronic trading than it was when everything was going through guys down on the floor. The liquidity providers are there and they're getting paid to facilitate and be involved and be aware of what people are trying to accomplish. But they don't quite have the advantage that they used to have down on the floor.
Well said, sir. And yes, listeners, one of the things you don't want when you're trying to roll a large position is massive turbulence in the markets. Keeping things nice and even keel until you get your roll done is usually ideal. And March of 2020 was anything but quiet and calm and tranquil, that's for sure. Mingyue, we've talked a lot of different nuances of rolls on the European rate side. We are starting to come up to that big quarterly rates roll, from March to June. What are you seeing shaping up in the marketplace already as folks are starting to line up? And what are you anticipating for the next big roll season, Mingyue?
Yeah, of course. That's a very good question, especially as we are now entering the more active roll period for the Eurex contracts. We usually consider three factors when analyzing the roll. The first one is evaluation. The second one is positioning, and the last one is CTD-RV. So in the valuation part, we estimate the theoretical value of the roll based on the current market conditions. For example, the repo rate, how many trading days are left, and whether there's optionality. So that's the first component of valuation. And the second part of our framework is positioning. Positioning is important because if market is very crowded and the roll can deviate from the fair value as well. So for example, if an investor is long the 10-year bond contract, they need to sell the front contract and buy the back contract. So that's effectively selling the roll, as Rex just mentioned. So if the overall market positioning is very long, many investors will need to sell the roll, and all else equal, that would put bearish pressure on the roll. So that's the second point, positioning. And the third part of our framework is CTD-RV, which stands for the cheapest to deliver bond relative value. This is because the deliverable bond basket can change over time, as we discussed just now. Some bonds enter the basket if they meet the criteria, and some may exit the basket.
Okay.
So if the front contract and the back contract may not have the same CCD bond, this matters because the two bonds do not always move one for one. If the front CCD bond rechans or cheapens versus the back CCD bond, then the role could change as well. So that's our framework. Basically have three parts: valuation, positioning, and the CTDRV. And these are also the key things we are watching for the March to June futures role. Yeah.
All right, then let's keep rolling, pun intended. A lot to get to, and we're already starting to come up against it, which is wild. Time flies when you're talking tasty, delicious rolls. But Rex, obviously, there's a whole broad array of fixed income products over there on the Eurex front. As you're watching these, which ones typically kind of come off the board first from a rolling perspective, and which tend to go last, sir?
That can be different, and I think the analytical framework that we just heard about, kind of dictates the speed and the timing issues, the amount of basis positions that investors may have taken in addition to outright long and short positioning. So meaning where somebody has a combined position on where they're exposed to futures, to fixed income futures, but also have the corresponding underlying bond position so that they're only looking at the basis between the two and the development of, any price gyrations between those two. I don't think there's a general rule of thumb. I mean, we'll typically map out, and everybody in the industry does this as well. There's automated tools to do this. You'll look at things like the pace of the roll. There's no, rule of thumb which one typically goes first. That your longer duration products would tend to move in terms of rolling earlier. The one point I didn't want to leave our listeners without is the relative importance of the roll overall. The amount of physical deliveries is a fraction of the open interest. It's so good to get your underlying knowledge set right, and it's so important, to know the nuances to the equity index world, to be cognizant of delivery baskets and switches of CTDs, of market positioning. And is the roll expected to richen or to cheapen over time, depending on the client positioning? But at the end of the day, most of the exposure actually rolls into the next month. The amount of physical deliveries that we see and monitor at Eurex in our fixed income suite can be lower than 5%, is often lower than 5% of open interest. So you may have 2 million contracts out there in open positions, and only 30,000 actually go into delivery.
Russell, we're talking a lot about nuances here when it comes to rolls, early setups, late setups, how all this positioning is established in the marketplace. From your perspective, as you're looking at this different type of positioning, what does this tell you as you're looking ahead? Obviously, everyone's looking in the rates complex. Everyone's looking to try to read the tea leaves to see what all this translates into expectations for rates in the future. So as you're watching these nuances of these rolls and these roll mechanics, what inklings does this give you for future rates expectations, sir?
Since we were talking about kind of the quantitative aspects of the roll, I pulled up some, how I am, I pulled up some data. And when we rolled, which one do I have here? When the Bobl was rolled from December to March, it looks like it really started to kick in on November 25th and ran through about December 3rd. So about over 8 trading sessions until the open interest flipped from December to March. You could see it coming. Like on the 25th, the open interest for the back month jumped by about 31,000. It went from 14,000 to 58,000. Usually it's in the 100 to 200,000 range. So you can start to pick up by looking at the open interest, and I think that's what Mingyue was saying earlier. Was they kind of focus in on the open interest to get an idea as to how people are going to, are they in the is the roll kicking off? How's that? So you can see it volume wise, and I would think that we're pretty close. I guess we're a few days from seeing a March-June roll. It's probably going to start kicking in the next day or so, I would assume. So, but I just decided to pull some numbers to see how it progressed.
Always nice to have some data in your back pocket. Mingyue, you have been invoked. Obviously, we're focusing here mostly on the European rates complex, but a lot of our listeners may be more familiar with the U.S. rates complex. Obviously, there are active and vibrant roll markets in each of these. As you're looking at both, what are some of the nuances or differences that stand out to you between the European rates roll market and what we see here in the U.S.?
Yeah, sure. They do have some differences, although conceptually they are quite similar. The first difference is timing we just discussed. So in other words, when the roll is most liquid and when most of the roll activity takes place. Generally, US and UK contracts roll earlier, while European contracts roll later. This is mainly because their first notice dates are different. So if investors want to avoid physical delivery, they need to adjust their roll activity depending on the contract. And the second difference is who is trading the roll, and this is partly related to the contract specifications. On the UI side, the tenor ranges from 2 year to 30 year and have a 6% notional coupon. Some may also call it underlying coupon. And for Eurex contracts, most also have a 6% notional coupon, except for the 30-year UB, the book sold contract, which has a 4% notional coupon. And the UK gilt contract also have a 4% notional coupon. This matters because when yield levels are closer to the notional coupon, if all else equal, there tend to be more optionality value. So some investors trade the roll because they believe there's a mispricing in that optionality. Yeah, so that's the key differences.
Well, Rex, Russell has anointed you as our duly appointed market structure guy here on the show this episode. So you get to tackle the notion of, obviously, Mingyue just broke down some of the nuances of the differences between the U.S. and European roll markets. But from your perspective as our market structure guy, are there really structural differences you're seeing from a roll perspective?
I think she beautifully covered them. I'm not going to try and dodge any bullet there, but Eurex has a delivery date on March the 10th, whereas the gilt contracts in the UK and the Treasury contracts have what she noted as a delivery month. So this gives the sellers the optionality to deliver the underlying bonds anytime in the entire month of March. And that's kind of what triggers open interest holders to take action, long before March 10th. Actually, as soon as March 1st comes around, the March contract is typically dead. In the current environment where notional coupons are significantly higher than the yields of the underlying bonds. Now, if 30-year bonds in the United States were yielding 6%, that would be a different story. If their notional coupon was 4%, that would be a different story. Then there could be value in holding back with delivery until the end of the delivery month. Problems we don't have in Eurex, fortunately for us. By design, we chose a delivery date, so everything is then typically handled before that. And the optionality that exists in these contracts is more about the underlying CTDs and not on the timing of when I actually conduct my delivery as a short position holder.
All right, we are already coming up against it, so I do want to jump to basis trading because it's kind of hard to talk about rates complex and rolls without at least touching on the concept of basis. But I know for a lot of our listeners, this may be a new concept. So maybe we'll start really quickly. Mr. Rhoads, kind of set the table for our audience. What are we talking about? What is basis trading and why is it such a big deal in the rates world, sir?
Well, it's think back to, I know I keep using equity futures as an example, but I feel like everybody understands those, especially your audience, because of the whole, everybody's involved in maybe index option trading, et cetera. But when you are trying to price a bond futures contract, you take the cash market, you add any financing, and you may subtract out any coupon carry. And you can find times that if the futures are too expensive, you can buy bonds and short futures. If the bonds are too cheap, it's not as easy, but you could probably do something that would be equivalent to shorting the spot and buying the futures, and you should be able to earn some sort of implied repo. Because these are massively liquid markets, and there are lots of participants in there that have their tentacles in a lot of different markets. The arbitrage pricing theory does get in here and should keep those futures prices in line with some sort of fair value. But just to be safe when you're rolling, you may want to just pay attention to both legs and make sure that the prices are not terribly out of line. I tell my students, if they think they found an arbitrage in the market, they haven't. Don't trade it. Call me. Had too many instances working at the options to where people thought options were mispriced for one reason or another. You will not find an arbitrage. There's 3 or 4 firms in the world that get all of them. And because of that, you can be pretty confident that the futures are a good representation of the fair value when you go about doing your roll.
I've lost track of how many listeners have written in saying, this looks like free money, this put, and obviously they're missing a circular or a corporate action or reverse split, something else. The devil is always in the details, but you're right. You're probably not going to stumble across an arbitrage that someone like a Jump or someone else already hasn't jumped on, pun intended. But let's keep rolling out to the land of basis. We could talk arbitrage for days. Let's get out to basis. Mingyue, Russell kind of laid the groundwork. You're out there obviously watching these markets day in, day out. Walk us through some of the opponents. How do you see these trades going up and being executed in the real world marketplace, Mingyue?
Actually, basis trade is a very popular trade among the hedge fund community, which requires a very high leverage and complicated calculation to make meaningful profit, as we just discussed. So as a reminder, it may not be suitable for many retail investors. So now back to the topic, we can first briefly review the definition of the bond basis. Bond basis is basically the price difference between the deliverable bond and the futures price times the respective conversion factor. So this is also called gross basis. We also have another concept, which is a bond basis net of carry, and this is also called net basis, which which simply subtract the financing cost from the gross basis. So that's a very brief introduction or review of the concept. And then one may ask, how can we trade it? Just like many other financial products, you can buy or sell the basis if you think it's cheap or rich. For example, if you think the basis price is too low and you want to go long the basis, you can buy the deliverable bond and sell the futures and finance the position in the repo market with the bond. And the bond here can either be the CTD bond or other deliverable bonds in the basket, but just need to bear in mind that the theoretical value of the net basis may not converge to 0 if there is optionality, or if the bond in the basis trade is not a CTD bond. So that's how to trade the basis itself. And apart from that, we can also trade the spread between 2 bases, or even trade it against other options, because trading bond basis is like trading an option. So that's how the basis trade work. Yeah.
Rex, the last word on this topic is yours. From the Eurex perspective, this basis trade has gotten a lot of attention in recent years, maybe more than you might think. Why are so many people fixated on basis trading right now, sir?
It has gotten a lot of attention, and there's a very high utilization rate, both in the United States and in Europe for this trade. This may have reasons, due to regulatory capital requirements pertaining to asset managers holding individual government bonds, where it's more advantageous for them to seek out synthetic exposure to government bonds with futures contracts. And the facilitation of liquidity in that market will then be provided by hedge funds who don't want to sit on this type of risk alone, but will then, if the asset managers are long futures, the hedge funds may be short futures and then end up buying the bonds so that they're effectively only holding a basis position. So there's a lot going on in terms of triangulation of liquidity between the repo market for the underlying bonds that are the underlying fixed income futures on both sides of the Atlantic, the futures themselves, and then also the cash bonds. On a day-to-day basis, Eurex also has a trading facility that allows people to do basis trades and to denote the trade as such, as a special subtype of block trading, so that if you send us a reference of the underlying bond that you've transacted, we'll let you do that in under 2,000 contracts for Bund, so under the minimum block trading size that otherwise, apply to these.
All right, Rex, that music means we are out of time for this episode. If folks want to learn more about all things rates and rolls and jelly donuts, where should they go? What should they do?
www.eurex.com is your resource of choice, and you'll find out everything you need to see there in terms of open interest figures, volume figures, pricing action during the rolls.
And Mingyue, you did an able job as our guest on the show. I hope you had a good time. And if folks want to check out any of the resources you folks have available over there at Deutsche Börse, maybe where should they go? What should they do, madam?
They can find our latest report on the Deutsche Bank research website.
There you go. Check it out. And did you have a good time, Mingyue? Mr. Rhoads?
Yeah. Nice talking to you guys.
All right. And
nice talking to you too.
Mr. Rhoads, if folks want to check out what you have cooking, where should they go? What should they do, sir?
I just keep showing up to your programs.
That works.
I've been around a lot. No, I put things out on Twitter. We're doing more and more on the Academic Market Insights YouTube site, where we do educational type videos. Along with what we just talked about, we're going to do one on rolling futures.
Oh, perfect timing, sir.
Whenever a topic pops up, we like to jump on that. We've also been doing a project where we interview old floor traders and hear stories of when everybody got to act like they were in junior high and make money.
Maybe don't say old, maybe say experienced, seasoned floor traders. So you'll get.
Dude, I got one that's on the floor in '68.
Oh well, yeah, that would definitely qualify.
That's old.
Old floor trader. I take my words back, sir. So check out Russell's various data and research. Of course, check them out on Vol Views every week on Friday as well. You know where to find that. Speaking of finding great content, of course, stay tuned if you're hanging out in the Pro. We will be back a little bit later on this afternoon with our Pro Q&A session. Should be a good one, diving deep into all the data on the options side with our buddy, Mr. Nick from Bantix and now Quick Options fame. So it should be a lot of fun there, diving into all of that fun. And of course, we'll be back throughout the rest of the week with our usual array of content until we're back very soon, another episode of the European Market Brief. Stay safe out there, everybody.
The European Market Brief, brought to you by Eurex, is your trusted source for the latest insights on European trading and market trends. As the home of Euro stocks, V stocks, DAX, and European rates derivatives like the Bund, Bobl, and Schatz, Eurex stands as the leading European derivatives exchange. Learn more about trading Eurex futures and options at www.eurex.com.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.